ability. But we're in kind of a nice place. We still have opportunity here to trim spend both above and below the line where we don't have to make those trade-offs. Low-hanging fruit, easy decisions to make, not necessarily easy to execute, but easy decisions to make. Nick mentioned maybe one of the most powerful ones, just a bloat of SaaS systems, of enterprise-based SaaS systems that are both costing us money and slowing down the employee experience, right? And just taking a across-the-board approach to controlling costs without sacrificing growth, that's the swing we've taken. We're not done with that yet. And so I think that's part of what's giving us that lift without having to compromise growth as far as the plan goes.
The only thing I would just, to elaborate a little bit on that, with a lot of those efforts in terms of just being a lot more efficient with our spend, we've been able to actually increase our actual investment, add direct quota carriers, account executives in the sales team this year, while still driving efficiency in the organization. And so that's allowed us to increase investment and go to market, some investment in our platform this year to still drive growth. And then I think if you come back to our real strong historical sort of expansion metrics, which we believe have an opportunity to be supported by the continued build out of the portfolio as compute matures in the market and we get more adoption, as well as the move into the mid-market. Our additional matters will accelerate new customer acquisition and expansion. And in the economy, we're really looking at kind of market share gains, which is not only gaining sort of new customers in a broad market, but also that expansion motion where we gain share within our existing customer base. And we think that motion is intact and sustainable.
Hello, Yanni Samolis from Baird. Thanks for taking the question. What are your assumptions for headcount growth into 2026, given the margin targets you've laid out there? Thanks.
Yeah. So it's sort of implicit in that, while there's not an explicit headcount sort of metric that we would share, what I would say is that broadly speaking, that headcount investment, because we're going to drive efficiency across all other spend, is going to move generally in line with kind of that increase in spending. And so you'd see acceleration in that and that investment to follow that pretty closely. That is that's our biggest line item.
Yeah. Just to add maybe a little piece of color there. There's two places where we are really looking to push hard on headcount expansion. That's direct quota carriers on the sales side and code writing engineers. And in those two places, we're finding savings across the organization to fuel that growth. And those are really the levers that drive that expansion and new customer acquisition for us that matters. And kind of part of driving this financial rigor is making sure we're putting as many of our resources into those two buckets as possible.
Ron, for you, Jim Fish with Piper again. You kind of subtly hinted at it in the presentation around a goal of 120% plus NRR. Mm-hmm. What are you assuming for, if my math is right, roughly 19% CAGR here over the next 3 years? Is it that 120? Because if so, it's like you're kind of implying new business is going to be flat to down here, or is it that underneath, in order to actually grow roughly 19%, you're actually assuming only like a mid-teens, like what we've been doing? And along those lines, how much of that cross-sell success or expansion is dependent on cross-sell as opposed to upsell of traffic?
Yeah. So I think two things. One is there certainly is, the modeling was kind of based after that, the current kind of growth rates, which is kind of that high teens.
No, man, I'm not.
I think when you look at NRR, the goal of getting there, it occurs over time. We don't get there sort of next quarter, and so we ramp into that goal. I think if we are very successful in accelerating, customer acquisitions and achieving the NRR goal, those actually would accelerate our growth rates.
Are you in any position
further than what we've assumed if both of those are very successful?
Thanks, guys. Brett, I think this is more of a question for you. So in terms of customer acquisition, so how are you competing with the public cloud guys when it comes to their deep, ability to offer kind of these enterprise price discounts with some kind of commitments Do you see that as a challenge, or is it kind of just proving the ROI to them using your service? Just wanted a little color on that.
Well, interestingly enough, we're on the marketplace for GCP and AWS, and we partner with them. They're driving, a fair amount of new logo acquisition for us. As far as competing with them, AWS shows up more than GCP does, but candidly, we have a superior platform, and we don't have, we're not seeing a lot of competitive overlap there.
Okay. So is it just kind of going, talking to the customer, seeing that this is the ROI you're going to get from using our service and the latency and all the speeds you're getting versus their product here?
Correct. Yeah. Same, selling against the competition that you would expect, whether it was AWS, GCP, or Akamai.
Sure. Thanks.
To that point, though, our competition really tends to be, Akamai, Cloudflare, some of the point solutions we talked about. The mid and spend commit on the big cloud marketplaces, it's actually a tailwind for us. We're on those marketplaces. People can retire that spend commit by choosing FASTLY. And so, yeah, we're all for it. Sounds great. Yeah.
Thank you.
Great, thanks. So just want to look at R&D and CapEx, and what is the right sort of long-term intensity for those, either as a percentage of revenue or absolute dollars, to make sure that you're appropriately investing in the business? And then long-term, where do you think channel sales can be as a percentage of overall sales?
Yes, so I think looking at CapEx, I think for the foreseeable future, the sort of 6 to 8% of revenue is a good metric. I think to the extent we continue to roll out efficiencies, I think there's opportunity there, but I think 6 to 8 is a sustainable level of capital investment in the business. I think as the business scales, I think you could see R&D coming down into the high teens. We're running a little over 20% right now. I think you could see that come down a few percentage points in that. I'd say kind of looking into that mid-term model of 3 years and then out to the $1 billion level.
And what about the partner question?
As far as a percentage of revenue?
Yeah.
Look, we're early days on our partner program. We do believe that there's a significant opportunity for us to really drive a new sales motion in a massive market that's never been tapped in by the channel partners. So I'm not going to comment on the exact percentage, but we have plenty of upside for our business going forward.
Is there a way for you to maybe break down for us the drivers of growth between sort of your core CDN opportunities, security, new products? Is there a way to sort of maybe deconstruct that a little bit in terms of your top line growth assumptions? Thanks.
FASTLY now losing all the gains.
At a macro level, I think the way we kind of look at our business is we have our core business, which is primarily the delivery business, probably growing sort of in the single digits, high single digits. And then the security, which is really the growth engine today, which is driving a lot of the growth. And I think as we build that out, there's an opportunity for that growth rate to accelerate. And then you sort of look at what I would sort of characterize as our incubation products, which have very low revenue contributions today, probably de minimis, that over time, as they become more meaningful, we see the adoption of compute increase and becoming meaningful revenue. Those become adders to the growth drivers in the business.
There's one more piece of color here. We don't talk about it too much, so I hope Fern doesn't get mad at me. But in our core business, content delivery, we look at that. When we look at that split by verticals, and Brett talked about this vertical focus approach. In media and entertainment, we've got amazing market share and real-time media, vastly so fit for purpose. But I think the transition we're seeing in the market is, hospitality, and retail, not just e-commerce, travel, all of this stuff, all of those verticals. We have relatively low share there. We can push the growth rates there much higher than in media and entertainment. And that diversification of the verticals in our business and this new vertical focus that Brett and the team are driving has a real opportunity to drive, that kind of growth portfolio level, speed, even in the content delivery, non-media part of our business.
And I think those industries are really starting to see that the performance and experience at the edge is really important to those businesses, just like it was to commerce early on, which I think is driving interest as those companies moving to the edge, some of that being new customers versus customers who might be migrating from an existing player, which provides a quicker sales cycle and or an implementation cycle.
Yeah, we got we'll just get to you in a second, Mark. We have a question on the virtual front, a little bit of a follow-on, I think, to maybe Jim's question, but what are the assumptions behind the 800 to 900 million in revenue for 2026? In this person's opinion, it's a little bit aggressive relative to consensus. Here to comment.
Yeah, I think the assumptions that I sort of spoke about is that we really maintain the growth rates that we're sort of seeing this year, which is really in the high teens. If you look at kind of where the midpoint of our guidance is, you sort of look at that growth rate, you get somewhere between that, 800 and 900 million. If it accelerates greater, we get to the 120%. We see the acceleration of new customer acquisitions. You can see a path to the higher end of that number. Current business levels, take us kind of to the lower end of that range. So that was really kind of the thinking behind the range.
Hey guys, Mark Zhang from Citi. Maybe just to round out the revenue contribution side of the picture, any sense of in terms of geography, should we expect more growth coming from the international side? And if so, should we expect more investments there? And how you guys expect to tackle that geography? And then second part of the question is just more on capital allocation. Good to see, I guess, your free cash flow trajectory. Any sense of where capital will be allocated? Anything on the leverage side you would like to address? Thanks.
Great. I'll take the international thing, and I'll ask Brett to help me with capital allocation.
Perfect.
I think the international space for us, and I hate to characterize our business as domestic international. We're an international company, but the U.S.-based business is it's a large share, and the international space, the non-U.S. business, is certainly a growth opportunity for us. It's growing faster than the regular business. That part, we have absolutely opportunity in geographic expansion. But I'll tell you, there's so much opportunity in penetrating the mid-market, unlocking the channel. When it comes to regional expansion, we're looking at that, very conservatively. Our business in Western Europe is great. We have, a very healthy business running in Japan and ANZ, and we're looking at other areas and being very kind of strategic in where we choose to invest. But I think the higher leverage for us in the next 18 months at least is channel activation, mid-market, and this new vertical focus that we're seeing in Brett's team. And that's really going to be our focus in the midterm. Anything you'd add there?
I would just say, we're going to be selective on what markets we enter. We've got a very efficient model that we deploy for resources when we enter a new country. So we'll be selective. We want to make sure we're being good stewards of the company's money and managing our overall expense in the sales organization, but we'll be very selective. We'll make sure we're well prepared before we go into any new markets.
Okay. And then talking about capital allocation, I think at a high level, I would look at similar to how we've looked at it over the last year, which is, looking at our balance sheet. We have a convertible debt out there and looking really to manage that as well as manage our operations to drive, the best possible cash position to minimize whatever that net cash balance is, as we get closer to the convertible debt coming due. What that means is, we'll continue to look at where the debt's trading, and there might be opportunistic abilities over time. We'll continue to evaluate whether more repurchases make sense or not. We'll continue to focus on generating cash to reduce the amount of cash we need. We end up on the balance sheet. I think as you look to, related to sort of capital allocation is always the M&A question. I think we're really focused on executing the business today and the platform unification. If you look at the product portfolio that we spoke about, that Lakshmi spoke about today, we have the IP to be able to develop those. So there might be opportunity for small tuck-ins, but we don't see, a major gap that is critical to be able to deliver either on the platform leverage that Nick spoke about or the product portfolio piece that Lakshmi and Laura spoke about.
Your response, by the way, Ron, is prescient. We've got a question in from the virtual side. Can we expect more convert buybacks? Following it up.
We will do what we've done over the past 13 months is we'll continue to look where the converts are trading. There's a strange phenomenon that when we go out and buy, it tends to raise the price, which is unfortunate. But we will continue to evaluate if the buyback makes sense based on current market rates and where the debt's trading and the interest that we can actually earn on our funds.
I'll just add this on behalf of Ron. You know, the financial models, the financial rigor, and the accuracy of the models have really increased our confidence in the projection, which is why we were able to go out just a couple months ago and make that purchase on the debt side. And the model, we're only gaining more confidence in those models. So I think we're like, you know, as our confidence increases, I think we're gonna be able to make the most strategic decisions when it comes to that. Yeah,
Absolutely.
Thanks for the question again, Jim Fish with Piper. Maybe just on the product side, I know you guys are talking about unification here on the platform, but clearly we have, you know, the CDN piece, the security piece, and computed edge, and just trying to understand and kind of that 3+ year vision where that security penetration rate is today in terms of just customers using the security products, where that could end up in kind of that model as well as kind of that computed edge piece.
Sure. Yeah, look, the platform unification story, it's key for us right now for exactly the point you bring up. Our cross-sell, the penetration of our security product line into our network service customer base is still super low. It's actually a little different region to region. We did a little better in the US than Europe. And that just is an enormous opportunity where we can sort of pave that road by running this platform unification play. And we plan to be out in the market with a fully unified management suite, meaning no swivel chair between the technology at the end of the year. And I feel like there's a huge opportunity because just as you bring up, the penetration rate there in between the two product lines, it's not as good as it should be. It also is true, it goes the other way. You have a lot of security-only customers, especially in next-gen WAF. We have the opportunity to bring content delivery to them as well. So platform unification, it's about building better leverage in the engineering team, but largely it's for driving a better user experience and a better land and expand experience for the sales team, for sure.
Hey, thanks. Rishi Jaluria, RBC. Two questions. First, just following up on the capital intensity question from earlier. Can you give us a sense for maybe how underutilized your infrastructure was before that's allowing this lower capital intensity going forward? And maybe alongside that, how should we differentiate between where you're getting efficiencies out of on the software layer and how we should think about that versus maybe running capacity a little hot, right? And trying to avoid that pitfall. Thanks.
I think that actually it's a great question for Nick. I should tell you, when our hardware, when our capacity is running at a certain level, that's when we think about the utilization of that. We think about it as in that moment of time, but we have the opportunity to push efficiency.
This is kind of boring. I'm not gonna lie.
Into that through software.
Let's
and
see
in
what
doing so
the
effectively,
CNBC
we're
is
able to
talking
run
about.
at 50% utilization for the same traffic that was 75% a year ago. And that's the difference that matters. And I think, you know, that's the real focus on Nick's team. Help me out here.
I think you really said it, Todd. It isn't so much that we were running an idle network, it's that we've squeezed a ton more capacity out of the network that we had. And I don't think we're done doing that. We will continue to do that as long as we can.
Question up front here.
Of the revenue today, how much of it is more sophisticated CDN versus things like delivering media where the performance really matters, but it's more bulk traffic? And how does that matter for pricing over time? Yeah, I'm trying to get an understanding of how much intelligence you're delivering in addition to just traffic.
Sure. I mean, hard to quantify. I understand the challenge there. Look, when we look at our customer base, they're
Everyone's on break? Well, that sucks. Market seems to be breaking down into the close here. Okay, let's go back to Fastly's presentation. Are they done? Oh, they're done. Oh, okay. All right, well, let's go back to CNBC now. They are still on break, these bastards. Well, maybe I'll just show some charts. Seriously. Amazon made a nice move today. Y'all stay on commercials. Zug versus Elon in a ring. Who you got? I got Elon. Actually, I think Zug could whoop Elon's butt. Zug been training. The markets closed at a really interesting level. Tomorrow should be interesting. S&P closed at 43, 80, 81. Interesting level at highs, high of day. So we should see what tomorrow does. I'm watching now, Service Now, and Snow, as Nvidia talked about data center a lot in their investor day or shareholder meeting today. So it should be interesting tomorrow. We'll see what happens. We got Fastly here at the closing bell or whatever. Anyway, guys, so thanks for tuning in. See you tomorrow.